Hello, my name's Tom Shan. I'm a UK Chartered Tax Advisor and Trust and Estate Practitioner. I hope you enjoy the following presentation on the UK taxation of offshore funds. Please note that the information contained in this presentation is provided for general informational purposes only. It does not constitute any form of legal or other professional advice, and it should not be used as a substitute for advice tailored for your specific circumstances. Thank you. The purposes of the following presentation are to explain how the investment activities of an offshore fund can result in a loss of UK tax revenue, discuss how the enacted legislation aims to prevent an underpayment of income tax, explore the tax implications for UK resident investors, and assist in the identification of offshore funds. There are certain types of offshore fund investments that, when disposed of, may trigger an income tax charge instead of a capital gains tax charge. Now, the rationale behind HMRC assessing any gains on the disposal of certain offshore fund investments as offshore income gains is a consequence of how the entity reports the income derived from the underlying shareholdings of the fund. Many offshore funds will grow the fund by accumulating and investing some or all the income. An investor who doesn't receive a distribution from the fund will neither pay income tax on the accumulated income as it accrues to the fund, nor at the time of disposing of their units, and this is because the accumulated income has been capitalised. The offshore fund legislation aims to prevent this roll-up and conversion of income into capital, and it achieves this partly by classifying offshore funds as either transparent or opaque. A transparent fund can be defined as a fund where any income received from the shareholdings owned by the fund is taxable on the investor directly. The fund manager should provide the investor with a voucher detailing the proportion of the fund's income to which they're entitled. And because there's no loss of income tax to HMRC, transparent fund gains are within the capital gains tax regime, so we needn't consider them any further. But many offshore funds are opaque for tax purposes. With an opaque fund, the investor is regarded as owning units in the fund, rather than a proportion of the assets held by the fund. And any voucher provided by the fund manager to the investor is likely to include only income that has actually been distributed to the investor. Therefore, HMRC will assess to income tax any gains made by a UK resident investor disposing of their opaque offshore fund units unless the fund has adopted UK reporting fund status. Any offshore fund losses continue to be treated as capital, so would not be available to offset against any non-reporting fund gains. Therefore, UK reporting fund status gives a UK resident investor capital gains tax treatment on the disposal of their opaque offshore fund units. An offshore fund that has entered the UK reporting fund regime is required to disclose to HMRC the income it's accumulated during a reporting period. Income earned by a reporting fund during a reporting period which is not distributed is known as excess reportable income, and a UK resident investor is subject to a dry tax charge on excess reportable income. This means they'll pay income tax on income they've not received. It is calculated by multiplying the excess reportable income rate by the number of units held by the investor on the last day of the reporting period. It should be included on the foreign supplementary pages of the investor's self-assessment tax return. And excess reportable income is deemed to be distributed to the investor on the earlier of the date the report is made available to investors and 6 months after the end of the reporting period. It is this deemed distribution date that excess reportable income is treated as being earned for income tax purposes. The treatment of excess reportable income depends on two key factors. Firstly, the nature of the assets held by the fund, and secondly, whether the fund is structured as a company. I'd like to bring your attention to the fund classification heading. Here you can see the funds are either classified as bond funds or equity funds. A bond fund is an offshore fund where more than 60% of its holdings are interest bearing. The excess reportable income is assessable as foreign interest. Whereas an equity fund is an offshore company where 60% or less of the holdings are interest bearing. The excess reportable income for an equity fund should be included as foreign dividends. If the offshore fund is a unit trust rather than a company, the income should be reported as foreign miscellaneous income. Excess reportable income charged to income tax should be added to the base cost of the investor's units, thereby reducing the capital gain on a later disposal. By way of an example, let me introduce you to Liz. Liz is a UK resident investor and she purchased 10,000 units in the X-Equity Fund on the 1st of May 2019 for £2.50 per unit. The fund has a policy of distributing 20% of its income to investors and accumulating the rest. The X-Equity Fund is a reporting fund. It prepares its accounts on a calendar year basis and makes distributions to investors on the 31st of March each year. Excess reportable income is deemed to be distributed 6 months after the end of the reporting period on the 30th of June. We can see from the table that income received by Liz is assessed in a different tax year than the excess reportable income. Because the excess reportable income has been charged to income tax, it's added to the base cost of Liz's units. Liz disposed of all her units on the 30th of November 2023 for £4.50 per unit, so she received £45,000. The allowable deductions in calculating her gain were her original acquisition cost of £25,000 and the £7,600 excess reportable income. The £12,400 gain was assessed as a capital gain. If an investor establishes that they own units in an offshore fund, they should refer to HMRC's approved reporting funds list to check whether the fund is listed on it. If the fund is on the list, they will need to consider the reporting fund effective date and the cessation date where applicable. Has the fund changed its reporting status during the investor's period of ownership? If a fund has not been a reporting fund throughout the entire period of ownership of the investor, the whole of any gain arising from the disposal of their units will be charged to income tax unless an election has been made. An investor may choose to make an election through their self-assessment tax returns to treat themselves as disposing of their units on the day the fund converted to or from being a reporting fund. The deemed consideration is equal to the net asset value of the investor's interest in the fund. The net asset value represents the net value of an entity, and the price per unit can be calculated by dividing the total assets less the total liabilities by the number of units in the fund. Where a fund converts from being a non-reporting fund to a reporting fund, any gain arising on the deemed disposal will be assessed as an offshore income gain. The base cost of the investor's units is then uplifted, and any gain arising on the actual later disposal of the investor's units will be subject to capital gains tax. Now let's return to Liz to see an example of a fund acquiring reporting fund status. Liz, as we know, is a UK resident, and she purchased 10,000 units in the ex-equity fund on the 1st of May 2019 for £2.50 per unit. But on this occasion, the fund was an opaque non-reporting fund. On the 31st of July 2022, the fund acquired UK reporting fund status, and Liz chose to make an election to treat herself as disposing of her units on that date. The net asset value on the 31st of July 2022 was £3.50 per unit. Therefore, the deemed consideration in computing her gain was £35,000. The allowable deduction was the £25,000 original acquisition cost of her units. Because the accumulated income was not subject to income tax, it was not an allowable deduction, and the £10,000 gain was assessed as if it were income. She would not have received any cash to cover this tax liability. On the 30th of November 2023, Liz disposed of all her units for £4.50 per unit, receiving £45,000. The allowable deductions in arriving at her gain were her uplifted acquisition cost of £35,000 and the £2,200 excess reportable income covering the period 1st of January to the 31st of December 2022. The £7,800 gain was assessed as a capital gain. If the units stand at a loss on the day the fund acquires UK reporting fund status, no election is required. Instead, the investor is treated as having invested in a reporting fund since the original acquisition date of their units. If a reporting fund ceases to be a reporting fund, any gain arising on a deemed disposal will be assessed as a capital gain, with any post-conversion gains taxed as an offshore income gain. There are many different types of offshore funds, so the starting point is to refer to the documentation provided by the fund manager. If the documentation confirms that the fund is a reporting fund, refer to HMRC's approved reporting funds list to check whether this remains the case and when the fund entered the reporting fund regime. An ISIN number makes identification much simpler. If the documentation is silent on the reporting status of the fund, or you don't have any documentation, you may need to consider the following questions to establish the fund's reporting status. Firstly, is the investment in a mutual fund? And secondly, is the mutual fund an offshore fund? Before it is possible to establish whether the investment is an offshore fund, it is necessary to know if it's a mutual fund. In Section 356 TIOPA 2010, mutual fund is given the meaning of arrangements with respect to property of any description, including money, that meet conditions A, B and C. Condition A is that the purpose or effect of the arrangement is to enable the participants to take part in the benefits arising from the acquisition, holding, managing or disposal of the assets held by the fund. Condition B is that the participants do not have day-to-day control of the management of the property. Investors in unit trusts do not have control of the management of the assets, so will fall within Condition B. Condition C is that a reasonable investor would expect to be able to realise any investment based entirely or almost entirely by reference to the net asset value of the assets under management, or alternatively, by reference to an index of any description. Open-ended investment companies issue and cancel units to satisfy investor demand and fall within Condition C. The next step is to determine whether the mutual fund comes within the definition of an offshore fund. The three forms of mutual fund that fall within the definition of an offshore fund are a mutual fund constituted by a body corporate outside the United Kingdom, a mutual fund under which property is held on trust for the participants by trustees outside the United Kingdom, a mutual fund constituted by other arrangements that create rights in the nature of co-ownership, where the arrangements take effect by virtue of the law of a territory outside the United Kingdom. Subsection 1C does not include trading partnerships, which might otherwise fall under the rights in the nature of co-ownership part of the definition.